Oatly just did something for the first time since going public. It actually turned a profit. So today we're going to dive right into their Q3 financial report, and we're going to look at it specifically through the CFO's eyes to see exactly how they managed to pull off this major milestone. Let's get to it. Okay, so right off the bat, here is the number that has got everyone talking. A positive adjusted EBITDA of $3.1 million. This is the very first time they've been in the black since their IPO. It's a huge deal. So the big question is, how on earth did they get here? And here's the bigger picture when you put it side by side with last year. Revenue's up, gross margin is holding pretty firm, and that adjusted EBITDA, wow, look at that swing. It went from a $5.1 million loss to a $3.1 million gain. That's a positive shift of over $8 million, and it really sets the stage for this whole turnaround story. All right, so let's start at the top line. That 7.1% revenue growth, where did that actually come from? Let's break it down. Now, what's really interesting here is that this growth wasn't just some lucky break with currency exchange rates. The real engine was a 6.6% jump in volume. I mean, they simply sold more product. And this is so important because it happened even with their pricing and product mix working against them a little bit. It shows you that the fundamental demand is there. That's the real story. Okay, so selling more is great, but we all know that doesn't automatically equal profit, right? So how did Oatly turn that extra revenue into a positive bottom line? This is where you can really see the CFO's strategy at work. And this just illustrates the game plan perfectly. It's almost beautifully simple. First, they boosted their gross profit by $4.3 million, basically making more money on each carton they sold. And second, they slashed their SG&A costs, their overhead, by $3.8 million. So make more, spend less, that's the path to profitability right there. So how did they protect that gross profit? Well, as you can see, it was a real balancing act. On one side of the scale, they got a nice boost from closing their Singapore facility and other supply chain wins. But weighing against that, you had some serious headwinds from inflation, especially higher labor costs in Europe and some struggles with volume in North America. They just managed to navigate all of that perfectly to keep their margins steady. Now, looking at Oatly as just one big company can be a little misleading. The global numbers are really a mix of three very, very different stories playing out across their main markets. And wow, this slide tells that story perfectly. In Europe and their international segment, things are looking great. Strong volume growth fueled a massive $9.5 million jump in profit. But then you look at North America, and it's the total opposite. Revenue actually went down, dragging their segment profit down with it by $4.5 million. It's a perfect split screen of where the strategy is absolutely firing on all cylinders and where it's still facing some real challenges. And then you have Greater China. I mean, that 28.7% revenue growth looks absolutely incredible, right? But the CFO made sure to add a really crucial piece of context here. Some of this was just due to the timing of when customers placed their orders. So yeah, it's a fantastic result, but they're basically telling everyone, hey, don't expect that same kind of explosive growth next quarter. Okay, so profitability is one thing. That's a huge win. But a truly healthy company needs more than just a single good quarter. So let's pivot a little from the income statement and take a look at the company's underlying financial health. We're talking cash flow and capital structure. And here is another really impressive number. Their free cash flow was $22 million better than it was in the same quarter last year. What that means is they're getting way, way better at managing the actual cash that's flowing in and out of the business. And that is a vital sign of a stable company. And CFO Marie-José David, she summed it up perfectly right here. Our cash conversion cycle was below 40 days, which is the best level since our IPO. In simple terms, the time it takes for them to turn their inventory into actual cash is shorter than it has ever been. That is a massive operational win. So on top of managing their daily cash, they also did some major financial housekeeping. They reduced a credit line they weren't using much, issued some new bonds, paid off a big loan ahead of schedule, and even bought back some convertible notes. Think of it like reorganizing your own personal finances to have less debt and way more flexibility. It's smart stuff. And what's the direct payoff for all that financial maneuvering? A pretty tangible $5 million. That's what they expect to save every single year in interest payments. That's money that now goes straight to their bottom line instead of to the bank. So, after a quarter like that, a real milestone quarter, what does the rest of the year look like? let's check out the official guidance they've given to investors. Looking ahead, they are sticking with their full-year targets. They still see revenue being about flat to up 1%, and they're holding to that adjusted EBITDA goal of $5 to $15 million. But, and this is a key detail the CFO added, they now expect to land in the bottom half of that profit range. So that's some important expectation management right there. And that really brings us to the big picture, right? Oatly has finally hit that profitability milestone, and they've proven it can be done. But the real question now, the one everyone will be watching, is can they turn one positive quarter into a sustainable, profitable trend? That's the story to follow.